who does what in this kind of relationship. Like if a client's listening to this, what is the thing they should rely on their accountant to do versus what their financial advisor should be.
This is Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement. Today, we are joined by CPA Jordan Stealey.
Because there's always this crossover of who gives advice on the conversion or there's always
who's doing what, like what scope. Yeah,
I know a lot of advisors that run from the Roth conversion. I know a lot of CPAs or accountants that don't want to get involved in that either. And sometimes by the time you're getting the information in tax season, it's too late to do.
Yeah, exactly.
The previous season, so you need like the advisor probably to bring it up to the client, and then hopefully loop all three parties in to do things correctly.
Yeah, my biggest pet peeve is that clients don't have a great source of educational standpoint from like the 8606 forms for those, because they come in April 15th or approaching the April 15th deadline, and all of a sudden is this relevant to taxes? And I'm like, yeah, it might be for your contribution basis. Yeah. Because a lot of times too, with obviously tax forms coming out on your guys' side at no like fault of your own. It's just the bigger clearing firms are pushing these dates back every year, that they'll get this and they'll just be like, oh, is this relevant? And I'm like, yeah, 100%. Like myself and your financial advisor we should have a conversation about this.
Calls every year like, hey, I just met with my accountant and they're looking for this form, but I don't have it. And it's like, you do have it. Like log in your portal, it's there too. It was mailed to you also. But that's just people.
Yep. Or in May, they'll get the 54. I can't remember the code, but it's the information only. Like we recategorize this, and this is your basis for an IRA.
Yep.
And I'm like, okay, let me just take a look, and then it's usually leads to an amendment because we have to adjust and file their basis so that it's not a problem down the road. But that's one of my big things. The QDCs are also just big driver of a lot of times. I think I was talking to you about this, is that I see like a lot of clients that for many years, so many people itemize because you could write off your credit card interest, you could write off everything. And I know the car interest is a new thing that came back with the big beautiful bill,
but it's not really defined clearly from what I can tell.
Yeah, it's very hard. It has to be vehicles that are after the first of the year, and it has to be American made, but it can also be like cars that are finally assembled here. So it's just
like Toyota is like
a lot of Toyotas, a lot of Kias, a lot of Hyundais. But those are also interesting because a lot of people don't realize that like some of them are like 51% happens in Korea. Some of them are built here. So if it's built and finally assembled here, it qualifies. But if it's 51% Korea, it doesn't. Right. So it's something that like, as this starts to mature and this deduction starts to mature, I think that more people are going to be conscious about like when they go in for their next vehicle purchase and being like, what's the assembly ratios on this car? Because if you've ever looked into like the car door, it will tell you like, okay, this percentage on most cars will say this was manufactured and assembled 55% of the time in South Korea or something like that, versus if it was one of the ones in an American factory. Yeah, it's such a small thing, but it's
I wonder how many people are actually going to do that.
I think if you're talking about someone, because it's a situation where if you are in an itemized category, it is potentially thousands of dollars in extra deductions. And if you are buying, especially if it's an American made, if it's a GM or Ford or anything like that, you're going to be pretty safe no matter what. But there are, like you said, Toyota actually produces, I think, more cars here than they do in Japan.
I think the Toyota Tacoma, maybe, or one of the trucks is like the most
it's
US.
100% built here. Yeah, there's just because there's not much more of a market. Yeah. There's not much of a market outside of Canada and the US.
Right. All right. We better start officially, huh?
Yeah.
What do you think?
Yeah.
All right. Let's do this.
Okay.
Sit up and look professional for 2 seconds and I'll slouch back in a minute. All right. Welcome back. Oh. I don't know. I don't really have a good clip on this one. That's not too close? You sure? Yeah. All right. We're good. Welcome back to the Roadmap to Retirement podcast. Jordan, introduce yourself to the people.
I'm Jordan Stealey. I own Redwood Tax and Accounting, or consultants here in Rochester. We're found right now in Bushnell's Basin, but we're moving closer to the city. So if you're nearby, feel free to reach out. I'm a tax accountant by trade.
All right. Good introduction.
Yeah.
What made you get into accounting? We'll start there.
Initially, I was going the pre-law route before the pandemic, and I was going to do tax accounting or tax attorney kind of work, and then realized really quick that was with the LSAT and like law school, it wasn't really targeting what I really wanted to do, which was working more in like kind of the tax / nitty gritty of the financials versus writing up contract and stuff like that. So tax was always something that I was going to do for as long as I can remember, and then just got into tax accounting, started my firm a couple years ago, 2023. Before that, I was a corporate controller.
Okay, cool. Good for you. So I guess the start of our conversation, you're coming from the accounting standpoint, coming as a financial advisor. And I think our industries have always had this big overlap around tax time of who does what. So I thought maybe a good starting point for our conversation is just talking about, in your mind, and I have my own ideas, of course, but if you're talking to your clients, what do you think they should expect from you as the accountant versus what they'd expect from their financial advisor?
Yeah, a lot of it just comes down to professional kind of timing. So a lot of clients they get a little bit more hesitant to have their financial work advisor reach out directly or have things submitted directly to my secure portal and vice versa. So something I'd like to work with clients a little bit more when I onboard them is saying it's okay that your financial advisor and myself, we can do a lot of things behind the scenes, make things a lot easier for you. In November, we can start doing a lot of the year-end planning stuff so that you don't have to come to us closer to the holidays and having delays on that front. And then also just a lot of the timing with the forms, you don't have to do a lot of the nitty-gritty setup when the forms start coming through middle February, March. We can get your client profile, especially if you're a new client, set up before then, and then we get rocking and rolling and things come out of the pipeline 2-3 days versus 10-14 days. I think a lot of it's professional timing, making sure that our schedule of events, like forms that come from you guys, and then also how that translates to the tax return.
Okay, so you're taking it from the standpoint of working together as a team, so the three parties, the client, the advisor, and the accountant, working together to make sure everything is done with a focus on the timing of really when forms come out. And I think that's one of the biggest frustrations for the end client is they know they've got a meeting scheduled with Jordan to do their taxes, and they've been waiting for their custodian, Fidelity, Schwab, whoever it is, to send out the form that they need, and they either missed it in the mail or it hasn't come yet. So I think a lot of times maybe if with the right disclosures and the right permission, if me and you can talk directly, it makes the client's life a lot easier rather than being the middleman in it.
Yeah, correct. And I think that also has something that a lot of clients will step away from that too, is the double-edged sword of if you and I are doing everything behind the scenes, where does that leave me as far as like an update goes? So I think that's important too, that you have the right financial partners, tax accountant and financial advisor, to make sure that that transparency is also whereas you might initiate something and say, hey, our tax forms are going to come out February 16th. As soon as they come out, we're going to have them pushed to your client portal for a joint client, and then make sure that like the client is fully aware of that. So I think that's the hesitation where I see a lot of like newer clients come in, and I have to say, it's okay, we can work together, but I'm also the type of accountant that's going to be proactive enough to say, hey, your financial advisor got everything to me, your file's complete, I'm going to roll into like the pipeline now. Okay. That's something I want to kind of reassure.
Yeah. So that's all kind of answering the question of reporting information, getting the 1040 done, all of that. Where do you think that you're involved, if at all, on the advice side of things? So if there's a move that is strictly within this tax planning realm, so maybe we talked off camera here, QCDs, Roth conversions, tax loss harvesting, RMDs. There's a crossover in our world. Do you get involved in giving advice on those, or are you more concerned about the reporting of it after the fact?
Yeah, no, 100%. I find that my two kind of biggest points of contact with financial advisors and clients are inheritance, so transfer of assets across generations, or long-term advisors that have had a client, but they're like, we've been doing this tax loss harvesting for a while, or this client, they just revealed to me that they're donating $15,000 a year to this charity, and we didn't know that, so they will push that through and say, okay, here's $15,000, you can throw it on my schedule. But with 90% of people these days not really itemizing, it's a loss deduction, versus if your financial advisor and I can make that point click, we can go ahead and say, okay, you have $100,000 in capital gains this year. You're going to be paying 15% on that based on your income level. If you're already doing a $15,000 charitable deduction post-tax, why not do it directly from your retirement account? And then it's a above the line type deal.
Okay, cool. So we had a couple topics we wanted to cover today. I threw that other one at you of who does what. We may as well go into QCDs because we kind of already touched on it, but I always like talking about QCDs with clients because to me it's like the best kept secret in the IRS tax code. I think a lot of people don't know about it. And for our listeners that maybe aren't familiar with the term, it's a qualified charitable distribution, which is a way that you can take money from your pre-tax retirement accounts, or I guess it has to be an IRA. So I should say from your IRA and give it directly to a charity. In doing so, it's not taxable when it comes out of the IRA. It also satisfies part of your RMD or potentially your whole RMD, depending on how the numbers work out. I should say also you do have to be 70 and a half years old to do this. So a lot of our listeners are probably far younger than 70 and a half. So maybe they either want to file it away for a date in the future or consider bringing the topic up to a loved one that's a little bit older. So there's not really a question here, but what are your thoughts or what would you like to add to the conversation about QCDs?
Yeah, they're wildly underutilized, especially with my folks that have RMDs. I always say it's a champagne problem where people that have RMDs that don't want to take RMDs because they just have various other sources of incomes, pensions, Social Security.
Good problem to have.
Yeah, exactly. And they'll come in and they'll find out that, oh, I'm already taking the RMD because I'm required and then I'm donating it. Just skip the extra step there. But yeah, that's the biggest thing. It's just that I think it's not a lack of wanting to do so. It's not something that a lot of people are informed with. A lot of accountants, they'll do the prep work of doing your tax return, things like that. But some of these retirement accounts that they don't necessarily see the day-to-day because, and I know it's a bad example because it's not something you're going to use a QCD for, but like a Roth, I'll never see anything from a Roth account unless it's a 8606 conversion. That I don't even know all of these retirement accounts that these clients have potentially because I don't see any tax forms. And that goes back to the issue of if your financial advisor and your tax accountant are on the same page.
Yeah, as an accountant, you're in the dark because you're only seeing the income off of it. You're not even seeing the balances really. You might help them calculate the RMD, but usually not. That's usually the advisor doing that. Or if they're a do-it-yourselfer investor, if they're on Vanguard or something, there's a tool for that. So as an accountant, you're probably not really even aware of the asset level. You're just seeing the income that's reported. So for you might not even be aware that they have the giant pre-tax problem we talk about is somebody that retires at age 60 or early 60s and they've got $1.5 million in their IRA and they're living on a pension and Social Security. So they're not even touching that pre-tax bucket until they have to, which now is going to be age 75. So that $1.5 million turns into whatever, $4 million by the time they're 75. And now they've got to take that RMD out and they've done none of the right planning work up to that point. So they've got this huge RMD coming out. But their accountant, who maybe they've been working with for a decade and a half, was in the dark about all this because you're just reporting the income. It doesn't, in a way, when you're filing their 1040, what they have in their account really isn't relevant. So you don't know about it. So interesting problem to have. The other thing so QCDs, I think that we do the math on it and as professionals and just liking the tax efficiency of it, we're always looking at what if you're giving $30,000 to a charity every year and how much would you save on taxes and how does that affect your RMD? And the reality is most people aren't doing that, but we have a lot of people that they're 70 and a half years old plus, and maybe they're giving $500 to their church at Christmas or minor donations throughout the year. And it might not ever be that like huge dollar amount that makes a big difference from a tax perspective. But if you qualify for it and you can do it, why would you not do it tax-free?
Yeah, and I think my biggest pet peeve too is and it's such a simple little thing too to just throw in, and I always say it's similar to the energy efficiency credits that exist because most accountants won't put that as like a finer point for most people.
Sure.
But one of my biggest pet peeves is because I know these credits are hundreds to thousands of dollars worth of deductions that no one thinks about, oh, I did Windows this year, I can get a tax credit. That it's just a touch base email that's, hey, is there anything else that you can think of? Or do you take RMDs? Do you do this? Those are usually where I catch it. And that kind of something that's missed. So it's just something simple like that. Yeah.
Okay. I think we covered QCDs.
And then the other point where I see is when we get a third professional involved with estate attorneys, where they'll start setting up like living trusts and things like that.
Sure. Yeah, you can get into that or even donor advised fund or a different topic altogether, which maybe we won't go into a ton of detail, but I guess it's worth noting just for our listeners that if you're somebody that has largely appreciated stocks held in a non-retirement account, there's probably an opportunity there to donate them and create a tax advantage if you're charitably inclined. Like none of it makes financial sense if you don't also want to support a charity. So if you are somebody that's charitably inclined, there's a lot of opportunities out there to either use your IRAs for the QCD, you can use your non-qualified account to do a donor advised fund. So a lot to think about there.
Yeah, 100%. And then obviously you guys get into the mix of like how, and this is where I feel like our worlds get a little bit more of a complex situation where we're planning like distributions post-retirement across like structured accounts. A lot of my clients will come in and they'll say, my financial advisor, or worse, in a lot of cases, they have 20 different accounts because they don't consolidate. And then they'll say, I have all these pre-tax 401ks. What should I do with this? Or I have a Roth here and my spouse has a Roth here. Should we be taking these first or should we be taking it from our traditional IRA?
That's probably the biggest question we get is I meet with somebody for the first time and they're in their early 60s. They're either about to retire, they've just retired. And it's, hey, Alex, I've got these 10 different accounts. I know I have enough money to retire. I'm not worried about running out of money, but which account should I take it out of first? And to the point, and where I'm sure you're going with this, is like there is a strategic way to take it out. That there's all kinds of studies on this stuff, but you can make your portfolio last another 2-3 years in retirement just by the order that you take money out of different accounts and how you maximize each tax bracket and try to build to your profession's credit, like a tax efficient strategy, not just I'll start with this account just because, and then when that account's gone, I'll switch to the next account. So yes, consolidate accounts, but also have some technique about when you take money out of which account.
Structured, yeah. So a lot of times, a lot of my folks will say, oh, we retired 10 years ago. We've been really taking out our pre-tax income because the age-old strategy of put into your 401k, 403b, once you retire, your income falls off a cliff. And yes, it's a lower tax bracket effective rate, but it also doesn't account for if you have a $2 million portfolio, half of it's in a Roth, half of it's in a traditional IRA. You should plan over the next 20 years, 30 years, half comes from a Roth, half comes from that versus front-loaded from traditional and the Roth.
The reality too is most retirees that we're working with anyway, they have a large pre-tax account because if you're 65 years old now, 40 years ago when you started your career, like 401ks was this new thing that was rolled out and everybody's going to this default pre-tax savings. So like most of the generation that's retiring right now has 90% of their wealth is in a pre-tax account, and they might have a little Roth or an after-tax account, but like they have this big pre-tax bubble that needs to be unwound. So I think the default to what you're saying is people tend to just say, okay, I got this pre-tax bucket of money, and I know RMDs are coming down the road eventually, so I may as well spend that money. And then once I spent that money, it goes like, all right, well, I've got the Roth money that I've been deferring all these years. I've got tax-free growth on it, so now I'll spend that. But there is a sweet spot to massage both and take advantage of the lower tax bracket. Anything over a certain line, you probably want to take out of your Roth account and deal with capital gains as you need to from your non-qualified.
Yeah, and I'd say like the thing too that I'm starting in accounting professional in general is starting to see is a lot of people that are in this pre-retiree bucket of 40 to 58, 59, right before you hit the 60 kind of golden year, where they're starting to come in and they're starting to think about that, like how am I going to reduce my retirement once I do retire over time? And something that a lot of them are really, I don't say distressed, but shocked to find out is that you're already being taxed on something like a 1099 DIV every single year as a reported income. It's okay to recategorize that income into a Roth over the next, if you're 40, potentially 20, 25 years before you retire, without eroding the principal balance on that pre-tax account as well. And then also obviously hitting that Roth conversion limit. But a lot of people obviously are told from an early point that you can either do that because you can't contribute to the traditional IRA and the Roth IRA at the same time because of that joint cap. They just assume that I'll take the $6,000 to $8,000 deduction right off the top from my traditional IRA and just contribute to that instead of doing a conversion instead.
Yeah, there's a lot to be said there, and there's so many specific situations to get into. I know one thing we wanted to talk about today was like retirement strategies for business owners, and I find this a lot of times that people that start their own business, when they start the business, they're very focused on their business, so everything else is on the back burner. They're trying to survive. and they get to a point where they're making good income, hopefully, and some time's passed and they haven't focused on their own retirement. And it's very common that we find people that have a very successful business, they have good income, they've built a nice life with a good big house, nice car, all that stuff, and they've completely neglected to save for their own retirement. And part of the problem is, like, because they are self-employed, they don't get to start day one and just be automatically enrolled in a 401k plan with a 3% match like the rest of America. So it really takes a more deliberate approach for a self-employed person to make sure that they're saving. And then once they decide they want to save, they've got 15 different options of how they can do it. Again, something I have my own opinions on, but I'm curious if you have a business owner client come to you and you start to breach the topic of retirement accounts, what direction do you typically suggest they go from an accounting perspective?
Yeah, I try to tackle that a lot earlier than I feel like a lot of accountants do.
Good.
They'll come in and because it's that tax day deadline for SEP IRA calculation, it's not complex. And obviously, it's very hard to do a SEP IRA calculation on the percentage that you can contribute in like October when you still have a full quarter to go. But if someone comes in at the end of November and says, my December is going to look fairly similar, I'm not a seasonal person, you can apply this much to the profit calculation, we can have a pretty good number by the end of the year versus coming to a tax accountant when you're February to April rush that most accountants I've met are pretty quick with the turnaround because, again, it's not a super complex calculation, but you get into the thick of the tax time and, that's something that isn't priority number one when you have a filing deadline, that a lot of my self-employed folks miss out on that deduction.
I find a lot of people have a hard time like systematizing savings. So they do what you're talking about, and they go meet with their accountant, they get their taxes done, and usually they have this oh shit moment of I owe a bunch of money, and then they have a conversation of like, how can I lower my taxable income? And now we're talking about a SEP IRA contribution, which works, right? But they're not saving for the purpose of like systematized savings to build that nest egg. They're saving in here's the thing I can do to lower my taxable income, which is fine if it gets to the same end, but we want to be more intentional about what we're saving and making sure that if we are a business owner with a good income, we're chipping away at our savings goals throughout the year as well.
Yeah, and it's definitely really tricky for a lot of folks to do that dollar cost averaging that you might do with the traditional, to your point, like every month you do a percentage of your income, you get your match, versus throwing it into a lot of my clients. I've just been advising, like, I get that your profitability can be all over the place and timing is a lot harder to do like an estimation of 20% of my profit in this month should just go into this account, because what happens if the end of the year is not as good, so you test that 20% threshold. So what I usually advise my self-employed folks to do is to do a rough calculation based on your monthly or quarterly close and then shove it into a high yield savings to make that interest. And then obviously if your ratio comes back lower than what you've saved, it's a champagne problem. You contribute the max and then the rest just goes back into the business.
That's a good way to do it. We do something similar, but maybe a little bit different, as I have them set up a non-retirement account, and maybe they start contributing whatever $2,000 a month to their non-retirement account. It's liquid, they can have access to it early. Yes, there's some capital gains things to think about, but then what happens a lot of times is we get to April and they meet with their accountant and they figure out, okay, I'm going to make a $20,000 SEP contribution, and rather having to pull it out of like their business checking account or savings account even, we just already have an investment account and we can sweep it over to make their contribution for tax purposes. They can stay invested that way. But it's very similar to what you're saying with a high yield account. It's just hiding money from yourself, making sure it's there. And if at the end of the year you have more money than you need, champagne problem, everyone's happy. Yeah,
it's always that you want to maximize your tax situation, but worst case scenario in that you have a little bit of extra money to throw back into the business. Yeah, that's where you guys have your investment account versus that might be my accounting brain where I'm like, as a business owner myself, and then a lot of people are focused on what they do. They're not thinking about financializing their money. If they're an artist or if they're anything that isn't financial advising or accounting.
You and I think about this stuff all day, so we have a different perspective. I guess to me, like as an advisor, when I'm working with that business owner client, I want to make sure that I am somehow affecting their behavior for the better. So if training them to save, again, I'll use the example of just $2,000 a month into something, whether it's a high yield account or an investment account or eventually the SEP or whatever it is, like I want them to get in that habit. Because for a lot of people, if you just wait until the end of the year, you wait until you're filing your taxes, you've either spent the money on something else or you just haven't you haven't had that mindset. So it's not money that you're willing to part with.
And I think that goes to, there's plenty of those studies out there that show like most people that work with a financial advisor will end up with a certain percentage more amount of money just because there is someone that is in their corner saying, it's a behavioral thing, getting in the habit of doing that. And again, it goes into like, maybe you tuck too much away. Again, not a problem.
Champagne problems. It's also, I get a lot of questions from, most of my clients aren't this younger demographic, but I get referred to like clients, adult child, just started their new job. They're 22 years old. And we hop on Zoom or we have a very quick meeting just to get them going down the right path. And the question is like, how much should I be saving into this account or that account? And usually they're coming in with something that's actually sustainable. Maybe you start at 5% and your dad yells at you, and that's okay, but start with 5%. And a year later, let's go from 5 to 6%, and let's inch up and build good habits. And by doing that, we're getting the behavior where we need it to be. What I don't want is a 22-year-old to start off at 20% because their dad told them to, and then bills pile up, they get credit card debt, and then they go from 20 to 0 because they're panicking. And now they wake up one day and they're 40 and they've saved not enough, or they're still not saving anything.
Yeah, and that's my version of that I tell people. And again, this is where like I would say like financial advisors, you guys do a lot more of that behavioral instruction versus me. Accountant, we're risk adverse folks.
Really?
Yeah. So usually what I'll say is my general advice is I can't give you, like, within the scope of my practice, I can't tell you to go to Morgan Stanley and buy XYZ products. That's outside the scope of license and everything like that. But I can say you should talk to a financial advisor, but at the very least, you need to take like the free money things. And then also my big thing is obviously a budget, the accounting side of things. And I think that's similar to what you're saying, where it's get that minimum like 3-5% match, and then also have a savings plan in place. But where I even go that extra step is you have this budget that's set up, structured, you follow it to a T, or maybe you're under budget every month. That should be swept into kind of that investment account, or something that is maybe not locking them into a retirement account where they'll take a 10% penalty because they have to get new tires for their car all of a sudden 1 month. But at the end of the year,
we'll start with the emergency fund, right?
Exactly.
Like that example I gave of the 22-year-old, the dad said save 20%, but before you save the 20%, let's make sure that you have 3 months worth of bills sitting in your savings account so that when you need new tires, you're not calling your financial advisor saying, hey, I got to pull money out of that account because I got to go buy tires. Like, you should be able to cover the cost of tires without disrupting your savings plan.
Yeah. Or being risk adverse in your early investments. In your 20s and 30s, you shouldn't be looking at investing only in CDs because you're worried about having to take it out to put new tires on your car. You should be able to just have your financial advisor take 5% of an auto save and throw it into a aggressive portfolio.
Sure.
And not even think about it. So that's my general advice, is not a percentage, because I do get a lot of my folks that are, my dad and grandpa told me to save 10-15% of my income in this type of account, when really having the budget, and then also just saying every single month, if this amount of money goes into an auto save, I can forget about it and not even, it's that you get into that stealth multimillionaire logic where it's, you don't even think about that money because it's just accumulating that.
Sure. When you know you're not going to run out, you don't have to think about it.
Yeah.
So getting yourself to a position where you have it, so you're not worried about every line item. You mentioned a budget a few times, so I'm curious to dive into that a little bit more. I know it's not a topic we had on our list for today, but I always struggle with some people, and coming from the accounting background, you are probably almost definitely this kind of person, but some people can lock into a budget and have a lot of success with it, and that's the way their brain works. A lot of people we work with, though, they might do the exercise of opening Excel and typing $17 for Netflix and going down the list of their budget items, but they will never actually follow it. Like, the budget is meaningless to that person. So I'm curious what you've seen, maybe in your personal life, but definitely in your professional life, of like the success rate with budgets versus another strategy where, like, I might say, let's pay yourself first. I'm sure you've heard that term, but let's put money into that 401k or the Roth, whatever it is, first. And then whatever we have left after that, that you can go out and spend.
Yeah. So this is where I agree with you. Most people, unless they are like keeping receipts for everything, maybe 5-10% of people that are type A enough to stick to, if I budget $400 a month for groceries, I'm spending $400 or less, and I'm tracking that throughout the month.
Yeah, I can't do that.
Yeah, and a lot of people, I think that's like we're all subjected to marketing. We're all subjected to like these budgeting apps, and like, we'll get into this habit, we'll do that. And we're going to be perfect at maintaining a budget. My philosophy is more to look at this I look at it from as if I'm running my personal finances like a business where you have your variable and fixed costs. I have my mortgage every month. That is a non-negotiable fixed cost. That's going to be paid.
You should
first.
pay that. Yeah.
Or my car payment. I've got to go to work.
Yep.
Pay my car payment. And that actually, the biggest thing I think is, and you touched upon it earlier, is that it goes into an account and you can't see it. So you're almost hiding money from yourself. I think it's also applicable to paying your bills too. So it's okay to have 3 or 4 checking accounts for different purposes.
Sure.
And I find that works for most people more because they'll have their auto save one where their Roth contributions will go on automatic. They'll have their car payment one. Everything's on auto pay, things like that. And I think that's the first hurdle that a lot of people can get into a better budgeting structure versus trying to lump everything into this one account. And then obviously like you get into the danger zone of people. We live in a perfect example of that. It's like we live in a subscription model world. So all of a sudden it's,
The lifestyle creep gets up.
Yeah, I haven't looked at my credit card bill in 6 months, and all of a sudden I realize I'm spending $300 a month on subscriptions to
that you don't even
XYZ.
use. Yeah,
exactly. Yeah. So I think that's separation of finances, to hide money from yourself almost, so that when you have your kind of discretionary variable cost things that come every single month, that's where, if you know that is for eating out, traveling, doing these kind of things that you don't need to do to kind of function. And this is maybe my accounting, being in the financial world, at the end of the month when I have $200-300 extra, that's where I'm like, okay, I stuck to my budget psychologically. I might have spent more eating out this month versus on groceries. But I was still under the total discretionary spend for the month. Okay. And then I can sweep that in and say, call my financial advisor and say, hey, I'm going to sweep $200 into this account. So it's gone.
Okay. Yeah, that makes sense. I think it's just fascinating to see how some people have such a different mindset towards it. There are people out there, they're usually like my engineer clients, where they can bring in that spreadsheet and they will stick to it. And I believe them. There's also people out there that sometimes around retirement age, you're trying to go through this exercise of figuring out like what their monthly spending looks like. And they want to tell you like, hey, I can live on $3,000 a month. Okay. But you've been making $200,000 a year for the last decade and you've accumulated no money in the bank. So like, where's it going? Like you think you're spending $3,000 a month, but you're clearly not. So we do need to move on from budgeting, but I think we could talk about that all day.
We could talk about lifestyle creep and budgeting.
Yeah. So one more topic I want to touch on before we end. I know we're kind of getting to the end of our time here. We talked about the big, beautiful bill before we started recording. I know you've got some thoughts on it. And I know you could talk about it for 3 hours. So why don't we do this? Big, beautiful bill, maybe 3 points that you think are either misunderstood or everybody should understand for their tax planning purposes.
Yeah, I think my biggest thing, and probably you as well, just because we tend to have folks that are retirees and pre-retirees, so they're thinking a little bit more about like Social Security and stuff like that. The new senior enhanced deduction is something that I've gotten a lot of questions from after that bill came through. A lot of my seniors are saying like, how is this going to affect my Social Security and how's that enhanced going to do that? And just in calculating, and it's different for someone who's going to be, their total income is $300,000 or $400,000 a year versus someone who's $100,000 or less. But in general, most of your kind of middle income earners that are getting that Social Security, they're going to see a massive deduction across their Social Security, to the point where a lot of folks are actually just going to, I don't want to say tax-free, but it's going to be pretty tax neutral.
Sounds like a campaign promise, right? Tax-free Social Security?
I mean, it's but it's a little bit more complex because unfortunately it's not like just how can we take, in a clean world, ideal world, it would say, okay, your Social Security is just now tax-free. You don't even have to report it.
Used to be that way, yeah.
But a lot of folks, obviously, because now there's that next level where forever it's been this portion of your Social Security is tax-free and this portion's not. The deduction adds that extra layer of complexity, but I'm finding that in a lot of cases, my middle and lower income earners, especially, it's being wiped out. And then a lot of my other higher income earners are also getting pretty substantial deductions on that, where they're used to paying tax on 85% of their Social Security, that the net effect of that might have
cool
Social Security earnings.
So that's one. I think another one that's probably pretty obvious to talk about, especially in New York State, is the SALT tax deduction. I don't know what to say other than it's back.
Yeah.
Back and better
So
than ever.
that one is interesting because I think that goes back to the whole, are you at the itemization level? A lot of my folks that I'm seeing, that's going to be like a huge thing, is just we're seeing the PTET, like pass through filing things, not be as at the forefront of my business owners, because now where they were capped at, it's eerie how a lot of people are like just above it. I've seen of my business owners, they come in close to 12 to 15,000. And that last part is the reason they've been doing the PTET for a while, which does save tax. But when you look at the actual net effects of that, it might be anywhere from $400 to $800, which depending on your tax prep fees, gets eaten up from just the filing, stuff like that. So this, I think, is going to help a lot of like business owners to avoid having extra steps, and it is actually going to reduce bureaucracy. So where the Social Security is, it's an extra step, this is one less step.
Okay, so that's a net positive, we think.
Yeah, as far as the tax goes, it's going to be, unless you're at the cap or approaching the cap, then it's obviously substantial. But for a lot of folks that are going to be just above it, I think it's just going to simplify things and save a few $100s here and there.
Yeah, simplifying things is a positive too. So that's good.
100%.
All right, so we got two. What's the third?
I know we were talking about the kind of, I don't want to call them the weirdo kind of deductions that came with it, like the interest on the car payments and stuff like that. If you're an itemizer, it's important to make sure that the final assembly or the majority of the assembly in the car, whether it's American made or a traditional American brand of GM, Ford, Chevy, Chrysler, Stellantis, yeah. And then obviously the Toyota, the Honda, they are half the vehicles tend to be majority assembled here versus not. So to look out for that when you're looking at your new vehicle purchase, I think that's an important thing. And then I think the thing that I'm seeing most with my non-retirees is the no tax on tips and overtime deduction. That one has been a question that I've gotten quite a few.
No one knows how to do it.
Yeah, so the guidance on it is still very coming out day to day on that one.
This is how politics work. They just say a thing and then they leave it to the rest of us to figure out what the hell they mean.
Yeah, this is one of those ones that I think 2 or 3 years from now, once we have a much more formal program put out by the IRS, there might be a lot more like amendments that come through with this one on income.
And then they'll have new tax codes, so none of it will matter.
Yeah, the one thing, exactly. My one thing that I'm telling people that to prep for these calculations is to look at the income across. It affects my folks that are married a lot more because it's based on individual versus single folks. That's the case with any tax return where it's married joint versus not. It's going to be a lot easier for me if it's one person's income. Everything's going to go through. But a lot of people might not maximize that deduction because they're looking at it from like this is my income, this is my income track. So I think my biggest advisory on that one is we're definitely going to see some tax advantages from it, especially folks that have a lot of their income comes from tips and overtime. But also I'm advising extreme organization on that one, making sure you have a very solid paper trail, especially with like overtime from your employer.
Right.
I'm going to need to see pay stubs that like clearly denote this is OT pay. Or a lot of my folks that are being affected by this are like servers and bartenders too.
Well, people in the cash businesses weren't claiming their tips anyway.
Yeah,
it doesn't really affect. I mean, it does affect them because now they can do it.
I would not
legally,
recommend
but
not reporting income.
we're not saying that. To be clear, you should report your income. But the reality is that the bartender probably wasn't claiming every penny that they made.
Yeah, which I think that might also be an interesting change this year. That because that's on the table, a lot more restaurant owners might potentially claim that just for their own business deductions now.
Sure.
That'll be an interesting thing to see over the next like few years, how that's going to affect not only business owner taxes on that side of things for the employment tax deductions and then also salary deductions, but on the server, bartender, primarily tip type trade.
Well, I'm sure they'll figure it out. We'll know more in a couple of years, like you said. But I think we're at our time, probably over our time. So Jordan, thank you for doing this.
Yeah, thank
our
you.
Listeners, thank you for tuning in. Before we officially cut it off, where can people find you?
Right now, I'm across the road at 1160K in the Canandaigua National Bank building.
Okay.
But Redwood Tax is going to be moving its operations to the University Business Center in North Wind Village.
Sweet.
NODA.
Okay. Yep. Sounds good. All right.
Yeah. Thank you.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA and SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Individual tax or legal matters should be discussed with your tax or legal professional. Jordan Stealey is not affiliated with or endorsed by LPL Financial or Cultivate Financial Planning.